Personal finance practice problem using OneNote. Inflation and estimated increase in personal expenses. Let's talk finance, and this time it's personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, down in the 1131 Inflation and Estimated Increase in Personal Expenses tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculation on down below. We're looking at those time value of money calculations, present value and future value. This time, however, applying it to the concept of inflation and how that could affect our personal budgeting planning. So our information on the left, we have the personal expenses per year that we're assuming are the $66,000. That means we're estimating $66,000 on our general goods, personal expenses like groceries, gas, and so on and so forth. We're going to estimate that the inflation is 5%. So quick recap on what inflation is going to be and how that will affect our spending. The inflation, in essence, is the decrease in the value of the dollar. So the purchasing power of the dollar is going down, which means that in the future, we are expecting that we're actually going to have to spend more money in order to purchase the same stuff. So the calculation or estimate of what actually inflation is complicated. It's an economic kind of calculation. And obviously, when we look at our $66,000 worth of stuff, we bought a lot of different stuff, including like food and clothes and whatnot for the personal expenses. Not all of those things are going to have an increase in their price at exactly the 5%. We don't know exactly what that is. What economists do are trying to figure out what the average increase in the basket of goods are to try to distinguish between what that increase is due to for factors that are due to the value of the dollar going down versus other factors. So, for example, obviously, if there was a difference or a problem on farms or something like that, the price of cheese could go up or down or something like that, whereas it could be something different than the overall basket of goods. But if you look at the overall basket in general, we're trying to say that in general, the cost of things are going to be going up due to the purchasing power of the dollar going down. So that's going to be the general idea, and you got to factor in some component of inflation almost all the time. If you're in the U.S., in other words, inflation is usually ticked. They're trying to get inflation between usually like 0 and 3% because the argument is that they want to avoid deflation. In other words, they want to have enough money in the economy, which is like the lifeblood of the economy, to keep things going. They don't want to have too few dollars in there. They'd rather overshoot by a little bit and basically get like 1 to 3%, which we can plan for as long as it's a consistent 1 to 3%. So that would be a moderate kind of rate of inflation that we'd still have to take into consideration with our planning perspectives. Now, note that inflation is something that historically has gone up and down over time periods. So if you are planning for a long period of time, as you would want to do for your full planning for like retirement or something like that, you will go through periods of times over your lifetime where inflation are higher and lower, most likely. And if you're in a period of high inflation, it can be difficult to see that inflation could be down at some other period of your life. And if you're in a period of low inflation, like we are in 2020, for example, we had a period of low inflation then. It could be the fact that inflation can go up. And it's hard to, when you're in a period of inflation being level for a while, it's easy to start to say that the Fed has it figured out and inflation's never going to go up, for example, in the future. And then inflation will sometimes go up in the future. So it's unlikely, looking at things historically, that we've got things completely figured out. We start to think that we're too smart sometimes, I think. And then inflation might get out of control. And then hopefully we get it back under control again. So the point is, you got to plan for some kind of inflation. If you're looking for a longer term perspective like retirement planning, then it's going to be an even more relevant factor given the fact that inflation will probably fluctuate more over that longer horizon, at least for some part of the time period. Okay, so what we're going to do is we got the 66,000. We're going to say 5% inflation, which again is a little bit over the cap that they usually shoot for, but the Fed might shoot for something over 5%. in order to try to even out, past years or something, and then have an even like 2 to 3% or something like that. But again, the Fed could misshoot and make a mistake too, which has clearly happened in the past, and we could end up with higher inflation at some point. So you got to take into consideration on the risk. So first we'll do this with our basic table down here. We're going to say we have our table, and let's do this year by year and say we're starting off with inflation of the 66,000. Now this table looks very similar, and notice I even put investment up here. This isn't really the investment. This is actually expenses that we're talking about there. But it would be a similar calculation if we had basically an investment. In other words, if we have an investment, which we've seen in prior presentations, we would typically say this is our starting point that we have in our stocks or our bonds or our savings account, and we're trying to see the rate of increase that will happen. We would then use a future value calculation to see how much we would have then after a set time period, for example, this time period being 2 years. Now, this is going to be a similar type of calculation, but we're basically taking into consideration the expenses and how much we're going to need to cover those expenses given the fact that the purchasing power has gone down over the 2 years. Note when you're thinking about an investment situation, if you're saying I have 66,000 and I'm trying to see how much I will get if I get a rate of return of 5%, this rate of return should include or probably be more than what you expect the inflation rate to be, right? And your real return in terms of purchasing power would really be basically how much you earned minus basically the inflation. That would be your real return in terms of purchasing power. So you got to take into account, of course, again, the inflation. So now we're just thinking about inflation, thinking about this is going to be the value of the dollar that's going to be decreasing, causing us to need to spend more in order to purchase the same amount of stuff. Okay, so now we're going to have our 66,000. We're going to multiply it times the 5%. So 66,000 times 0.05. That's going to give us our 3,300 more dollars to get to the same amount of stuff. If I add that then to the 66,000, we're going to get the 69,300. That's how much we need to purchase the same stuff a year from the starting point where it only took us 66,000 before. Note that we can also get to that end result number by taking 100% or 1 plus 0.05 or 5%, 105% or 1.05 times the 66,000, also getting us to that 69,300. If we take that and multiply it times 0.05, we get then the 3,465, adding that to what we had to spend before to get the same stuff, 69,300. That brings us up to the 72,765 that we would need to spend to buy the same stuff, in essence, that we bought a few years ago or 2 years ago where we only needed 66,000. Now, again, note that the prices of all the stuff we're buying doesn't mean that it's going to go up at the same rate, because this is an estimate as to what the average increase will be based on the decrease of the dollar rather than each individual item. But that's going to be the best estimate that we're going to have here. So we're going to get the 72 times the 0.05. Hold on a second. That wasn't 0.05. 72,765 times 0.05 is going to give us then the 3,638. And if we add that then to the 72,765, we're going to get then the 76,403 that we would need to purchase the same amount of stuff, whereas 3 years ago it only took us 66,000 to consume that stuff. And then if we take the 76,403 times the 0.05, we then have the 3,820 plus 76,403. That means we're going to need another 80. We need 80,000 then, 223 to purchase the same stuff. Where, like, I remember 4 years ago, I purchased this amount of stuff for like 66,000. I remember a time when I could buy a Happy Meal burger meal for like $5. You know, that kind of stuff happens. Way back when you can buy a piece of bubble gum for a penny. And so you can see it does have an impact even at a modest inflation rate of the 5%, which is nowhere near really out of control inflation rates. So then if we go down, we can do the same kind of calculation with just the future value calculation. This time we're not going to go 4 years out, but simply 2 years out. The calculation would be negative future value. This would be an Excel calculation. Notice that negative will flip the sign, because if we have no negatives, the answer will result in a negative number. We can put a negative in front of the whole thing, like I like to do more properly, you should probably put it in front of the present value calculation over here. I won't get into the y's and whatnot here, but in essence, that either way, it'll flip the sign. Then we get into the brackets. The rate is going to be the 5%. And note, we could hard code the 5%, typing it in, but we're bringing it from the table, which is more good practice for Excel purposes, comma, number of periods is going to be this cell. We're going to say 2 years out this time, and we're not typing into as we could, but rather taking it from the table. And then comma, we have the payment. We're not using the payment, so we have 2 commas. We don't use the payment because that's something that will be applicable to an annuity table. This is a future value of 1 calculation. 2 commas, and then we get to the present value, which is our starting point at the 66,000. That then gives us our result of the 72,765, which is the same result we got after 2 periods up top, 72765. Then we could do the same calculation with a formula, which you might have to do like in a test question setting, where we have the future value equals the present value times 1 plus r to the n. This time we're actually solving for the future value, so we're using it, to get the end result of the future value. So straightforward calculation. Plugging that in, we'd have the future value equals the present value of 66,000. That's our starting point, times 1 plus r, which is 0.05 or 5%, to the number of periods, which would be 2. So we take it to the power of 2, and that should give us our result. I'm going to plug that into a table type format. Quite useful to do this. This was a similar format as you'd seen like tax returns or in a financial kind of statement type of format. Very good practice to do. Something you don't practice in schools with as much, but something quite useful in practice to know how. So for this, we're going to take these 2 major components that are multiplied together. I'd like to see those 2 things in the outer column. Any other subcalculations I'm going to put into the inner column as a subcalculation indicated by a colon, an indentation, and being brought into that inner column. So we got the 66,000 outside, and then we got the 1 plus r to the n, colon, means it's going to be a subcalculation in the inner column. Then we got the 1 plus r, so 1 plus the rate, which is r, that's 5%, that we're picking up from our table up top. Adding those together, we would get to 105% or 1.05. In other words, we get this 1 plus the 0.05 would be 1.05, or if we move the decimal 2 places over, 105%. We then take that to the power of 2, so caret 2. Now, you make sure that you have a proper calculator to be able to take something to a power of. Normally, this calculator has the squared function, but you might need more functionality if you're going more than 2 years out. So you might need like a scientific calculator, for example, to take that 1.05 and then use the good old x to the y to give you that caret to the power of 2. And then equals, that'll give us our 1.1025. There we got it. And then we can multiply times the outer column over here. Let's bring our calculation back to the standard calculator. Standard calculator, 66,000 times the 1.1025. That gives us our 72,765. Same thing we got up top. Note that this number right here, 1.1025, is the number that we'll see in the tables that we'll look at next time. This is kind of how they derive the tables that they put together, the tables that might be used, especially in test questions in a school setting where they take away your calculator, they take away Excel, and they act like you're doing this stuff like in a cave next to a fire, scratching little glyphs on a wall or something like that. And for that, we're going to basically use the tables. Note that this is rounded out to 4 digits. If this was something that was 4 digits out longer, then you would most likely result in a rounding difference, meaning our calculation from the formula and from the Excel function would differ by rounding to what's on the table, given the fact that you can see the tables down here are brought out to 4 digits. That rounding difference could be something that a cruel test could then exploit by forcing you to use the table or not use the table, and having the answer be different by this minimal rounding amount, which would probably be insignificant in practice, but which can force you to use one method or another when you're thinking about tables. Okay, so now we got our tables, same calculation. On the tables, we got our rates up top. We got to make sure we got the right table. So obviously it's a future value table. We don't want an annuity. We're looking for future value of 1 table, not multiple payments, future value of 1. We got the rates up top. We got the periods on the side. In this case, we happen to have the periods being years, the rates being yearly rates. Note that doesn't necessarily need to be the case to use the table. For example, bonds might have a mid-year or half-year convention, 6 months periods, or you might have monthly calculations. The periods could be any period that you want to use, but the rates up top will have to mirror that, and that means that you'd be needing monthly rates or 6-month rates, half a year rate, and those rates are typically going to be quite small, and that's where the limitations in the table take place. So in this case, we got a nice, easy calculation for the tables, meaning we have the yearly rate of 5%, and we got the years of 2. So we simply go to 5 here percent, and the periods, which are in years, in our case 2, that gives us the 1.1025. So there we have it. That number right there from the table matches the number we did when we did the calculation up top for the future value. That's how the tables are in essence derived. Note that this coincidentally rounded out to exactly 4 digits, which is exactly the digits number that the tables are rounding out to. That's a coincidence. If that wasn't the case, you'd have a rounding difference. So then we got the 66,000, and we just multiply that out. 66,000 times the 1.1025, we get once again that 72,765. Same thing we got up here when we did the present values with the formulas, and the present value with the Excel function, and the present value for year 2 with the running balance.